Sell an asset for more than you paid and the ATO takes a slice.
The 50% discount that has existed since 1999 is being replaced from the 1st of July, 2027. This is the biggest CGT change in nearly 30 years.
Here is exactly how capital gains tax works in Australia and what is about to change. Let us break it down.
Let us start with what most people get wrong about CGT.
Most people think CGT is a separate tax with its own rate. It is not. Others think the family home is fully exempt forever. It usually is, but not always.
And almost nobody understands what is about to change from the 1st of July, 2027. Let us fix all of that today.
Here is the real definition.
Capital gains tax applies when you sell an asset for more than you paid. The profit, called a capital gain, is added to your taxable income for that year.
It is then taxed at your normal marginal rate. There is no separate CGT rate in Australia. It is just regular income tax on a specific type of profit.
What assets actually trigger CGT?
Property other than your main residence. Investment properties, holiday homes, vacant land. Shares, ETFs, managed funds. Cryptocurrencies.
Collectibles over $500. Selling a business or business assets. CGT is much broader than most people think.
Now let us talk about the 50% discount.
Hold a CGT asset for more than 12 months, and you get a 50% discount on the gain. A $100,000 gain becomes a $50,000 taxable amount.
On the top marginal rate of 47%, the tax drops from $47,000 down to $23,500. That is the power of the discount, and it is being replaced.
Let us compare the old system and the new system.
Old system, sale price minus cost base equals gross gain. Apply 50% discount. Pay tax at marginal rate.
New system from the 1st of July, 2027. Sale price minus indexed cost base equals real gain. No 50% discount. And a minimum effective tax rate of 30%. Same asset, very different outcomes depending on inflation versus growth.
Here is a worked example from Treasury's own documentation.
Zoe buys shares for $100 on July 1, 2027. She sells 5 years later for $125. Nominal gain, $25.
With inflation at 2.5% compounded over 5 years, her indexed cost base is $113. Her real gain is just $12. Slightly less tax than under the old discount.
3 rules to master CGT.
Rule 1. Track your cost base properly. Purchase price, stamp duty, legal fees, capital improvements, all count. Rule 2. Holding period matters. 12 months and 1 day unlocks the discount.
Rule 3. Timing of sale changes your bill. Selling in a low-income year drops your marginal rate. After 2027, the 30% floor blocks that strategy for high gains.
When does CGT not apply?
Your main residence is generally exempt while you live in it, and for up to 6 years if you rent it out. Assets bought before the 20th of September, 1985 are pre-CGT and currently exempt.
Personal use assets under $10,000, cars, and certain compensation payments are also exempt. These exemptions are worth thousands to most Australians.
Now the transitional rules. This is where it gets technical, but stay with us.
Assets sold before the 1st of July, 2027, the full 50% discount still applies. Assets bought from the 1st of July, 2027 onwards, fully under the new system.
Assets you already own that you sell after July 1, 2027, split treatment. The 50% discount on the value increase up to that date, indexation on the gain after. These rules will keep accountants busy for 20 years.
Now the 30% minimum tax.
From the 1st of July, 2027, capital gains face a minimum effective tax rate of 30%. This blocks the strategy of selling assets in low-income years like retirement to drop into a lower bracket.
Means-tested benefit recipients, including the age pension and job seeker, are exempt from this flaw. The 30% minimum changes retirement planning forever.
5 mistakes that cost thousands in CGT.
1. Not tracking your cost base. Every receipt for legal fees, stamp duty, and capital works matters. 2. Selling on day 364 instead of day 366. One day costs you half the gain.
3. Ignoring the 1st of July, 2027 transition. Buying after that date locks you into the new indexation system forever. These mistakes are completely avoidable with basic planning.
Let us bring it together.
You understand CGT is just income tax on a gain. You know the 50% discount ends from the 1st of July, 2027 for new assets. You know the exemptions and the transitional rules.
You now understand capital gains tax better than most investors and probably some accountants.
Thanks for watching. This is general information only, not personal financial advice.
Subscribe to Smart Money Decisions.
See you there.